The birds are go.
Dun, 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 dun.
Welcome back to QAVTK, episode 431. You're in week 5 of lockdown, and I'm in week 1 of lockdown, staring down the barrel of probably 5 or more weeks up here in Brisbane.
Well, it's good. Queensland's only 5 weeks behind now. They used to be 10 years behind.
How are you holding up?
Yeah, good. Yep.
That's good.
I mean, there's not much change to life, but yeah, no, all good.
You're wearing a shirt made out of crocodile skin by the looks of it today. Did you catch and skin that croc yourself? Croc Dundee, Kynaston?
No, it's not. Well, it's not leather. It's material. It's just a print.
Just a crocodile print.
Yeah.
Good stuff. Well, we've got a lot to talk about today in the market, a lot of news, a lot of things going on. I want to start with the QAV rankings. Thank you to everyone from QAV Club that's gone up to our QAV rankings spreadsheet and been throwing up their results there. I have to update mine and the QAV ones for last month. But there's some really good results trickling in from people that have been around for a while. 43%, 45% since inception. And I wanted particularly to give a shout out to Troy, who posted in our Facebook group, I think last week, that he's had a 54.61% return for the last financial year.
Fantastic, isn't it?
Sensational results. So congratulations, Troy. Congratulations to everyone who's posting their results on there. Like in terms of last financial year, Daryl posted 51.87%.
Plus 17% for the last month as well, I saw.
Yeah. So good work, guys. What else? So Afterpay. Big news for Afterpay today. They're being sold.
Yeah. Is that going ahead? Have you heard if it's been accepted or not, or is it just an offer at this stage?
Well, no. According to the Afterpay board have approved it, endorsed it,
okay, that's interesting.
Accepted it. Afterpay's board unanimously endorsed the deal in the absence of a better offer, saying an independent expert concluded it was in the best interests of shareholders, according to...
I reckon the board of Afterpay have gone, whew.
Yeah.
PayPal have just launched the competing product. Everyone's crowding the market. Regulators are having a look at it.
Yeah.
Ooh, offer.
Yeah.
Phew.
They've probably been... they're being acquired by Square, founded by the Twitter guys, Dorsey, etc. They've probably been turning down their offer for the last 6 months and telling him to go to hell, and then they're like, that offer. That's still on the table. Anyway, so I think the article says that the offer is about a 30% premium to what the share price was trading at. The Square offer of $126.21 per Afterpay share represents about a 30% premium to the stock's closing price on Friday, which is great news for Afterpay shareholders, unless they bought it 6 months ago when it was trading up around $160.
Yeah.
In which case, they're never going to see that money again. So it kind of depends, I guess, when you bought it.
Yeah, well, if you bought it after COVID when it was, $16 a share or something, you've done really well. So.
Done very well, yeah.
Good luck to them.
Yeah. What else is going on in the news this week? I want to thank Persian Master, whoever he or she may be, for a review of the podcast. They put up an apple. Appreciate that. I've been asking people lately to give us more Apple reviews, and I appreciate Persian Master taking the time. MML, Tony, what the hell happened to... What the hell, MML? That's what I want to ask. MML just sort of dive-bombed on us last week. What happened there? Because I think it's... Yeah. So I read a report in the morning that said they'd issued sort of a preliminary results, and they were saying, and I read it, it all sounded pretty positive and upbeat, and then the share price tanked like 30%.
Mm. Yeah, so MML, SLR, Silver Lake Resources, and Aurelia, AMI, also all had quarterly reports come out in the last week or so, and they all precipitated a share price decline because of them. And for different reasons, I guess, but it's sort of commonality there. The Medusa one was because their costs went up for the quarter. So Medusa, so there's a thing called all-in sustainable costs, and it's kind of the benchmark way of measuring costs if you're a miner, particularly a gold miner. And it's like cost of goods sold if you're owning an industrial company or a factory or something like that. But it does add in things like exploration costs, and it does add in things like overheads like corporate overheads. So it's trying to give you an overall picture of costs and to have one benchmark to compare mines with. And there's been a bit of a history to get to this stage. So way back when, like 20 years ago, miners were always judged by their cash cost, which was just what they spent. And then people said, hang on, if you're doing lots of exploration, the cash cost might be misleading because you're just looking at the costs that are associated with mining the ore, not exploring. If you're looking at, if you have to close the mine, there's remediation costs. So there's a whole lot of things which are excluded by just the cash costs of mining the ore. So the Mining Association got together and came up with a sort of combined metric for it, and that's evolved into all-in sustainable cost, which is the basic measure. The issue for Medusa was they came out with a quarterly report saying their all-in sustainable costs was, I think, what was it?
It went up to US $1,594 per ounce, up from $1,304 per ounce in March 2021.
Yeah, thanks. Thanks for finding those figures quickly. And if you think about it, the gold price is about $1,800 US per ounce. So at $1,600 US per ounce for the last quarter, they're closing in on break even, if not a loss situation for their mine. So that was the initial reason for the sell-off. However, they've also, in their quarterly announcement, forecast their end-of-year results, which are getting close to being finalised. And the all-in sustainable cost for the year on average was still down around $1,300, which is pretty standard for the gold mining industry. Most miners are in that sort of $1,200 to $1,400 range. Further analysis looks like for Medusa that they're doing some work on the mine. So up until recently, they've been what's called a shaft mine. So, you go down a lift, an elevator to get to the mine face.
He's talking about shaft. Shut your mouth. Sorry, keep going.
That's all right. And now they're putting a ramp in. So like they're putting what's called an incline in so they can drive trucks up and down to the mine face, which is an expensive thing to do, which is what's pushed their costs up because they've started work on it. And it's generally lumped in with exploration costs because as they drill to do that, they might find some more gold. So there's a reason behind why their costs are up. But as often happens with quarterly reports, the market doesn't stop and ask for a reason. It just jumps. Oh, costs are up, bad, boom, let's sell the stock. And that's one of the things that, Buffett's called out over the years and other people have called out over the years is we shouldn't have quarterly reports. They're just focusing everyone's attention on the short term. You should be looking at the long term. And this is a classic case. Medusa are trying to improve their long-term prospects, trying to make the mine more efficient, trying to get at a lower ore body by getting trucks down into the deepest part of the mine and not just guys in hats with jackhammers going down an elevator. So this is a classic case where short-term trumped long-term. That's that. There was a couple of other things with the other miners. So Silver Lake and Aurelia both had good quarterly reports, but they called out the fact that they were starting to see inflation in the mining industry. So contractors were costing more to hire. Other service providers were putting their fees up. And they were also finding it difficult to manage the COVID situation with fly in, fly out workers, for example. So there was good results, but then they kind of come with caveats. And so again, people are like at any sign of an issue, jumping and dumping the stock. That leaves us with a sort of decision to make. What do we do? So Medusa mining was in our dummy portfolio. It came back to the price that we paid for it, and I decided to sell and to buy something else on our checklist. And that kind of caught people by surprise. A couple of things. It's really on a case-by-case decision. So if we had bought Medusa at a lower price, it's still way above its sell price. If we weren't about to lose money on it, then I'd say keep it. I would wait before buying it because, as we've talked about before, I don't like buying things that are in a short-term decline, and that's where it stands at the current time for Medusa. The share price has retreated. I'll wait to see it turn the corner so we know we hope we're through the bottom. So that's the reason for rotating it in our dummy portfolio, and that's what we call Rule 1, don't lose money. And the logic behind that is that if the share gets back to what I paid for it, then I prefer to sell it and buy something else. And yeah, I might lose out hypothetically if the share price turns around from there. But I don't want to lose money, which I potentially could do or could risk if I held on to it and the share price kept going down. So there's two risks there. One is that you miss out on the upside because you sold out at break even. The other one is that you save the risk of losing money because it keeps going down. Essentially, it's cost you nothing for that insurance except for the transaction costs, I guess, because by selling at break even, we haven't incurred any capital gains tax liability. And we're kind of still exposed to upside because we bought another stock with the proceeds. And so, I'd expect that stock to go up anyway because it's high up on our checklist. So I kind of see it as being almost a free insurance on not losing money. That's why I sell when it comes back to break even. So for the people out there who are questioning why we're selling Medusa, it's because it was at break even, and I didn't want to take the risk of losing money on it. Now it can go both ways. We've had cases before, like we sold Ramelius Resources out of the dummy portfolio last year. When it got back to our buy price, I invoked Rule 1, and then Ramelius promptly turned around and rocketed up. So it can go against you, but we would have bought something with the proceeds of selling Ramelius, and that would have done well too because we had a good year last year. So I like to protect my downside. And speaking of Aurelia Metals, which is one which I have held through my break-even point, it's still been going down. So that was one where I thought, gee, is the market overselling this? It's back to what I paid for it. It's way above its sell price on our 3-point trend line. I'm going to keep it, and it's just cost me money since then. So I kind of keep it in the portfolio now as a reminder to me to apply Rule 1 next time it occurs.
Well, I was going to ask you, because with MML, I bought it on the 11th of June at its all-time peak of 94 cents. And then it dropped within like a week down to 81 cents. It dropped the further week down to 80 cents. And I held on to it because it was way above its 3-point trend line. Then it shot back up to 93, 94 cents on the 19th of July. And I was saying to Taylor, see, that's why you hold. And then I sold it a week later at 81.5 cents again. And it dropped back down. So yeah, I should have, if it dropped so quickly after we bought it, we maybe should have sold it faster, just gone, screw the 3-point trend line. Just, if you buy it and it drops, just get out.
Yeah. I think that's a safer rule. Yeah. In which case you would have taken a 10% loss, which you can use for capital gains in the future, but you are covering that downside that it's not just a 10% loss, it can keep going.
Yeah.
And look, to be honest, like I just gave a bit of a thumbnail sketch on quarterly reports for those 3 gold companies, but I don't want to get into having to know so much about gold mining that I need to analyse their quarterly reports and make an informed decision about, the share price drop. Is that a good or a bad thing? I'm focused on our checklist metrics and what to do from a portfolio point of view, rather than trying to work out whether the market's right or wrong about this particular gold stock now. So, yeah.
So, okay. Well, there you go. Lessons to learn. Mark and a number of people asked us with reference to MML. So how does Rule 1 override the 3-point trend line? If I understand what you're saying, it's if you buy a stock and then its share price takes a significant backward slide by 5 or 10%.
Well, below what we paid for it.
Anything.
If it's back to what we paid for it? Yeah.
If it 1%. If it goes down 1%?
Well, no, because oftentimes we'll buy something and it might drop 1% because our buying may have forced the price up by 1%. So that often happens, especially
Your
in
buying
small
might
stocks.
do that. I don't think my buying's doing that. But
well, you just may have bought on the wrong day, right? And it can be a 1% swing.
Well, the Cameron Kerr says that whenever I buy something, it immediately goes down. So, I mean, I'd be selling everything.
Yeah. Well, I feel like I've got a curse on me because we did a pull apart on Medusa Mining like a week ago or something, or 2 weeks ago.
Yeah, you were talking about how great it was on Phil Muscatello's show,
yeah.
right?
Yeah, that's right.
Whoops.
Yeah, so that happens too. Yep.
Yeah.
Whoops.
And you were doing MIL. It was your other one you were doing that had the emphasis of matter. Hasn't been a good week. Okay, but so if it
need to get out more. It's locked in fever.
If you buy something, it just shows that you're human, like all of us, Tony. I like it. If you buy something and it drops by X percentage, we're saying what?
If you bought something and the next day it was a 1% lower, I wouldn't sell because I think that's just sort of normal market volatility. But if you bought it and it went down, say 5%, definitely by 10%, I'd be selling out.
Right.
But the case I'm speaking of was Medusa Mining, where we bought it, it went up.
Yeah.
And it's come back to the buy price. That's much easier to put rules in place.
Right.
Back to rule 1. Yeah.
So if you buy it and it goes up and it comes back to your buy price, sell it, even if it's above its 3-point sell line.
Correct.
If you buy something and it immediately drops by 5 to 10%, sell it.
Sell it. Yep.
And if you buy something and it's been going up for a good period of time, then the 3-point sell line is our benchmark for when we sell.
Correct. Yes.
If neither of the first 2 conditions have been met, condition 3 holds.
I've just spent days reading a contract, so it's like clause 13.1 subparagraph G.
Yeah, okay. I hope that helps me. I hope that helps everyone else out there, and I will update the Bible to reflect that wording for future reference. I want to go check WWG now that I bought today and see how much it's dropped since I bought it. Because I had to sell Hum today because Hum breached its sell line on Friday and then jumped up today on the new after an hour after I sold it on the news of Afterpay. But it's come back, so it's okay.
So not only is the Cameron curse responsible for stocks going down, it's like they go up after you sell them too.
Yeah, acquisitions, $39 billion acquisitions happen when I sell something.
I got a stock I want you to sell.
Yeah. Imagine if I'd sold Afterpay and then that acquisition news came out. That would be the real thing. WWG's up. That's good. Now, you wanted to talk about oil last week, Tony, but we didn't get time. Do you want to talk about oil still this week? I know you touched on it briefly last week, but I think you want to go more.
Just quickly, yeah. So when I raised it, it was getting down towards the commodity sell price, but it's back up, I think, again into the mid-70s. So the sell price was about 66. So that's not really an issue so much at the moment. It was when last week, because OPEC had a bit of a falling out and there was some disagreement about what the volume target should be. And basically OPEC and Russia control what the oil price does by how much they let into the market. It's a cartel. So there was some disagreement there. Anyway, that's now passed and things have been smoothed over and the oil price is back up into the mid-70s. That's good. But there's been a couple of developments which are of interest. One is BHP have decided to sell off their oil business. So that was interesting, I thought. And that's, partly they're trying to assuage investors who want them to get out of fossil fuel. So they're out of coal and now they're getting out of oil. But that means someone's going to buy those oil assets and probably get a good deal, because I don't think BHP will be an intentional seller. They'll be a motivated seller, so they'll probably not get the best price. But anyway, we'll see what happens. I did think maybe Woodside or Santos might pick them up, but Santos have now gone into a tie-up with Oil Search, which is a company that's not on our checklist, but Santos is. Oil Search has been a Papua New Guinea oil explorer, and I don't think they're a refiner, but they certainly take the crude oil out and sell it. So export is what I'm looking for. But they've had problems for a long time, either with PNG from sovereign risk point of view, or just managing, operating in that kind of environment. And it's always been a real hit and miss, Oil Search. So Santos tying up with them is seen by the market as being a way of improving the operational capabilities of Oil Search. And Oil Search certainly does have lots of reserves. So I think it'll be a good thing for Santos, which is a share that I own and it's been on a checklist for a while. The interesting thing about the Santos approach is that it's a merger of equals. So it'll have to be approved by shareholders of both companies, and it'll mean that, I think Santos from memory gets the majority stake in the combined, or Santos's shareholders get the majority stake in the combined company, and Santos's board and management will take over and run it. The reason for that is that Santos doesn't have the PE premium to go and make a script offer for Oil Search. And that led me to think a lot about what's going on in the mergers and acquisitions market at the moment. It's starting to feel a bit like 1985, 86 all over again. There's lots of M&A activity, and the sale of Afterpay is a classic example of that. And it gets driven from time to time in the market, generally towards the end of a cycle, a boom cycle, and usually because it's fueled by debt or high PEs. And so both of those are happening in the market at the moment. The market PE is up, and that means that a company that's on a high PE, which I'm sure Square would be, it's a tech darling from the US. That's, I don't know what the PE for it is, but it's probably triple digit. That allows them to offer script to buy out other companies at a much more attractive basis than paying cash for the shares, because their script is basically overvalued. So you see this happening time and time again at this stage in the market. Companies who've got high PE ratios start taking over companies that have lower PE ratios, even though Afterpay has a high one, and leveraging that difference in the PE ratio, which is more attractive than paying cash for shares. The other way that they can do it is to get lots of debt, which is possible now because interest rates are low. And I think the classic example of that at the moment is the Boral takeover by Seven Group, which has basically happened. Seven have had to borrow a lot of money to have the takeover go through, because they weren't really trying to take over the company. They were just trying to increase their shareholding, and more people than they thought sold into their offer, which wasn't that great. It wasn't much above what the share price had been historically. And now Seven have a lot of debt, which they'll pay down because Boral are selling assets, including their US business, and then they'll return that capital to shareholders. And now Seven, being the biggest shareholder, will get the majority share of that. But I think they'll still potentially have a fair bit of debt to deal with. And that's fine while interest rates are low, but when interest rates start to rise again, we'll see, which sort of takeover experts have been over-leveraged. And we'll also see that when interest rates start to rise, which will affect high PE ratio stocks, and their PEs will drop, and that will just stop takeover activity from them. So it'll be interesting over the next probably 1 to 3 years to see how all these mergers and acquisitions finish up. And they can, as they did in 87, when you had all the corporate raiders like your Ron Brearleys and Adelaide Steamships and Allen Bonds borrowing heavily to buy out other companies. And then when interest rates started to rise, they all went bankrupt, and that sort of threw the market into chaos. That may happen again, may not, but it may happen again. So I think we're starting to see the seeds sown of that kind of play out for the end of this boom cycle.
Wow, okay.
Not trying to forecast, but I'm saying I've seen it before.
You don't think this time it's different, Tony?
I do not.
Nope. FMG?
FMG, I just wanted to make a couple of points, and it'll be interesting to see what happens when they report. And Rio has reported and has now come onto the checklist, quite high up in our top scorers list. They got a QAV score of 0.58. So Rio Tinto is another iron ore miner, which is a competitor for FMG. So,
sorry, while you're on that, what's your price to cash flow for Rio? Because mine's like over 10. I saw a lot of people on Facebook saying it was on the checklist, but on the scorecard. But for me, the PCF is very high.
Hang on, I'll just look it up for you. I'm getting for Rio price to cash flow. I have 1.6.
What? Sorry, don't choke to death. Wasn't that?
Excuse me. It was 10. It's now 1.6.
What do you mean it was 10? When did it stop being 10? I ran a scorecard last week and it was 10. I mean, I didn't do the manual yesterday.
They reported on Friday.
Oh, right. So what changed between when I ran this Friday morning and Friday afternoon?
Whole of the cash. Yeah, nice. So the last numbers were from December, and now they've had an iron ore price above $200 for another 6 months. It just does wonderful things for these iron ore miners. So we'll see the same thing with Fortescue Metals Group, but they're already on the top scorers list. But yeah, Rio's now on.
Right.
So I just wanted to talk about that before we go back to Fortescue Metals. So it's now into company reporting season. If you go into, for those people who are Stock Doctor subscriptions, you can look at the recent updates, which is worth doing at the moment until we start getting into the real bulk of the reporting season, which is next week and the week after. But at the moment, you can go into Stock Doctor and click on Tools, and then halfway down you'll see Recent Updates.
Ah.
And if you go into that, and I select all companies, and then for the update types, I deselect everything except for company financials updated, and then click refresh, and I've set the date range for this past week. There's only been 1, 2, 3, 4, 5 companies reported in the last week. So these are the ones that are starting to report for the financial season. I think most of those are listed investment companies which reported early. So we've got stocks one called Whitefield, which is an LIC, Brickworks Investment, BKI Investments LIC, Magellan Financial LIC. But we have got Rio in there, and one that's just come up in the last few hours called Oceana Gold, which we can look at. So rather than do a complete update, what I do for this is I go back into the tools, do a stock filter for today, download a new QAV download. But all I do is select the row with Rio in it, and then just pop that into my most recent download. which is a quick and dirty way of doing an update for Rio.
Sorry, just walk me through that again slowly. So you go into stock filters, and then do what?
Select the QAV filter.
Yeah.
Run it.
Oh, okay. Yeah.
Save it to the CSV.
Yeah.
And then rather than go through the whole process of doing an update of my master spreadsheet, which, as we know, can take half an hour or so.
Yeah.
And there's only been one company that's reported. I'll just open that download, find Rio Tinto, do a search, and just pull out that line, which has the new updated financials,
and paste it in.
To the latest download.
Oh, right.
You made me laugh, and my tea went down the wrong way.
Good. No, that's now I've set a benchmark. I have to try and do that once a week now. It's like, see if I can make Tony do a spit take with his tea.
Splurt, yeah.
So you grab the Rio line here, copy it and paste it in to your
so I do that in the QAV download.
Yeah.
QAV download data tab. I then go through and check the manually entered scores for Rio. Well, as soon as you do that copy and paste, you'll see the price to cash flow's changed. It's dropped back to 1.6.
And now I've got 7.11 now.
What?
Yeah.
Let me have a look.
I mean, I haven't done the manual data, but that's not going to change the price to cash flow.
That's not going to change that. Okay, so I've got Rio Tinto. Let me just go from left to right in the columns. I've got 30th of the 6th, 21 is the latest update. Sorry, let me just freeze the panes again.
Freeze the panes and the rest will follow. Freeze your panes, don't forget to swallow.
Equity, 77 billion.
Yeah.
Average trade, 132 million.
Yeah.
EPS before abnormals, 1.5.
Yep.
What's that? Yeah, 1,500 cents. EPS afterwards, 1,487. EPS forecast, $2.10 a share. So 2,100 cents.
Yep.
Share price, I'm using 131.69.
I've got 133.07.
Okay, I'll update.
Not going to make a huge difference, but yeah.
No. Price to consensus target 100%. Price to income val 102%. Market cap 49 billion. Net operating cash $30.5 billion. Free cash flow 1,300 cents. Borderline star stock. 371 million shares outstanding. 6.8% yield, etc., etc. ROE of 35%. Stock Doctor's is giving us a price to cash flow of 7.1.
Oh, that's what I'm looking at.
No, so we need to go across to column AG.
Oh, well, I'm not using your sheet. I'm using the Flitty.
Flitman's.
These are the Flitty sheet. Let me go and have a look on the other tab. Oh, Rio's not even showing up in this tab. Hold on, I need to clear all my filters.
So I'm getting operating cash per share of $82 and a price to operating cash flow of 1.62. That is strange, though. Normally, Stock Doctor is pretty similar to what I calculate it to be.
Yeah, well, I think Eddie Donato on Facebook, when I raised this question, said something about different ways of looking at the shares.
Yeah. Stock Doctor we use shares on issue, and Stock Doctor use diluted shares.
Yeah.
So let me compare the shares then. So
where's the hell
we are using, what am I using for shares outstanding? I've got 371 million. What is Stock Doctor saying?
Okay, yeah. Now in the QAV analysis, I'm getting priced operating cash flow of 1.62.
Mm-hmm.
Difference to Stock Doctor, 340%.
Well, that's worth investigating, isn't it? Let's have a look at that. So I'll call up Rio and Stock Doctor. Well, that's good. That's why we put that check in there to see if there's a big difference. Now, the shares on issue will be in the financial statements section. Financial metrics.
Eddie said, this is where you have to decide whether to use Stock Doctor diluted weighted number of ordinary shares of 1,628 million.
Yeah.
Results in a price to cash flow of 7.11 and score around 0.08 without entering manual data versus fully paid ordinary shares of 371 million results in price to cash flow of 1.62 and score around 0.54 without entering manual data.
So, yeah, that's Eddie's exactly right there. Let's explore it. So, Stock Doctor is saying diluted weighted number of ordinary shares is 1.6 million? Yes, 1.6 million shares. We're saying shares outstanding is 371. That's a big difference, isn't it?
It is.
Why would there be such a big difference in those?
Diluted weighted number of ordinary shares. What's 1.3 billion shares between friends, Tony?
That's a lot, isn't it? Let's call up the annual report. And we'll have to use the old one because the new one won't be out yet, I don't think.
Just between you and me, I'm flagging that we're 37 minutes into the show.
Okay. Well, do you want me to take this offline and come back with a reason?
No, it's fine. I just want to let you know because I don't want to work you for 2 hours like I did last week. I felt bad. So I just want to keep us both cognizant of the time. That's all.
Yeah, okay.
You know, the show is the show. So if we just do 2 questions and we do 2 questions, if we don't have time for that, I don't think anyone's going to mind.
Well, I'm going to have to noodle around here and find out what the difference is. So let's park that and I'll come back to people.
Yeah. Okay. Thanks.
I'll send you a stock journal maybe tomorrow and I'll go through it and try and work it out.
But
yeah, good point. That shouldn't be that far apart because normally the difference between fully issued shares and diluted is just things like options.
Right.
But they can't be, 6 times the number of shares.
Right.
On issue as options. I think there's a mistake there somewhere. I'll have to track it down.
Right. Oh, good pickup, Tony and Eddie on the Facebook page. Eagle-eyed Eddie, as I've often said. So, hey, Cameron in the editing room here on Tuesday, the 3rd of August. Tony did post on Facebook about an hour ago. I think there is an error in Stock Doctor. It looks like they have only counted the shares listed in Australia. Rio has a London listing as well. Looks like all the other data is for the combined company. I have just emailed Stock Doctor to confirm. I believe the correct shares on issue should be 1618.1 million. I get this from their annual results, which say, for the purpose of calculating basic earnings per share, the weighted average number of Rio Tinto PLC and Rio Tinto Limited shares outstanding during the period was 1618.1 million, being the weighted average number of Rio Tinto PLC shares outstanding of 1246.9 million, plus the weighted average number of Rio Tinto Limited shares outstanding of 371.2 million. Then Tony says, using 1618.1 million shares on issue changes the QAV score for Rio to 0.10. And then Tom Stevens replied, Tony, thanks very much for looking into it and following up with Stock Doctor. I think you've got the Stock Doctor hotline. They've updated it already. So that answers that issue, and it drops down from 0.54 down to 0.10 on the scorecard. But again, this strikes me as another example of what happens when we have many eyes in QAV Club looking at this stuff, picking up, anomalies and errors, and then we can address them. So, another great example of the power of the QAV community in action.
So that was Rio. I was going to talk about Fortescue Metals Group. I'll just do it quickly.
Yeah.
Really just a bit of commentary because I'm starting to see again some sort of late-stage market activity. So the fact that there's a high dividend being paid is a way of Twiggy Forrest taking money off the table because he's not going to keep it invested in Fortescue and try and grow the business. He's paying it out as dividends, which is a way of him getting money out of the company. They've got a dividend payout ratio, I think is now about 80%, which is quite high. And then they've got, of the 20% that remains, at least 10% I think is going to their new Fortescue Green Ventures business, which is trying to use hydrogen to make steel, amongst other things, which is a pivot away from mining iron ore. So that's another sort of tick on the late stage checklist. And then at the most, they're going to reinvest 10% in the business. So that's kind of getting pretty low for any sort of business to only need 10% capital to either, just to spend on the business. They're either replacing things or exploring or putting in new infrastructure to ship or all that kind of stuff. So I'm kind of forming the view that Fortescue is being set up to survive once the iron ore price turns down. The question is when that's going to happen. I don't know, but interesting situation. Now, Twiggy Forrest is probably the best entrepreneur I've seen, or one of the best anyway in Australia's history. So, if he thinks that hydrogen and the production of steel using hydrogen is a way to go, then he's probably right. And that could easily blow up into being a big growth area for the company, in which case Fortescue will be okay. But let's just see how it plays out.
So this new green investments company that he's doing is a subsidiary of FMG? I thought it was a separate interest.
No, it's a part of FMG.
Okay.
So he does have lots of other interests, which he's diversifying into as well. But
Right.
No, FMG is trying to find a way to use hydrogen to make steel, and therefore, I guess, sustain its market.
So the 80% he's taking off the table is what he's putting into his outside of Fortescue investments.
Yeah,
but Fortescue itself is trying to pivot.
Yeah.
Right.
Yep. Anyway, that's just for interest. We'll see what happens when the results come out. We'll get paid a big dividend. The share price is going to be driven by the iron ore price, which has gone on for a lot higher and a lot longer than people thought. And who knows where it's going to go to. I'm not trying to forecast it, but yeah, it's of interest that Twiggy is saying, this may be getting towards the end.
He's dug all the iron ore out of Australia. There's nothing left to dig out.
No, there's still plenty of iron ore in Australia. What he's saying is it may be worth less. Like, we can't go on forever in this purple patch, which is true. And he's saying I need some money to shore up my position when it does turn down.
Right. Okay, do you want to go on with these other news stories, or do you want to jump into questions? What do you want to do?
No, let's jump into questions. That's fine.
Stock of the week, cash converters for your pulled pork this week. We should do your pulled pork. It's a hit.
Let's see how I go. Can I drop the share price on cash converters?
Don't, because I own it. So be careful here, TK. I also owned MML. So you ruined MML for me. Don't ruin this one.
Well, I own MML too, so it ruined it for me as well.
Yeah, you can afford to have a thing ruined every now and again. I can't say much. You will one day.
So CCV, cash converters, most people would know what cash converters are. It's basically a pawn shop franchise.
Pawn shop?
There.
Really?
PAWN, like a chess pawn.
Oh, okay. That's less interesting.
Yeah, so it's a place you can go and trade in second-hand goods and either get paid for them or get a loan and come back later and buy them back. Been around for a long time, reasonably checkered career. Been looked at by various governments to see whether they were charging usurious interest in the past and asking people to take out loans on difficult conditions. So they've weathered all those storms and they're now coming back and doing okay. So whatever you think of cash converters from the point of view of providing an outlet for people to sell goods cheaply through, which they may have come via interesting means, not necessarily purchasing them originally. I'm trying to tread carefully. I remember when I was living in North Carlton when I first moved to Melbourne, and we were robbed and I lost my guitar, and the cops just said, "Just walk up and down Lygon Street to all the pawn shops. You'll get it back. Don't worry about it." It's like, sure enough, there it was.
Really? Yeah, anyway, you found it? Yeah. Wow. And what did you do then? Just told the cops and they went and...
No, I bought it back for $100. I had
insurance really?
Money.
Oh, yeah. Right. Okay. You still have it?
No, it was a terrible guitar. Very cheap Strat copy anyway.
Yeah. Hey, I've got one of those.
Yeah.
Anyway, kick up.
No, they're good, but they're not great. Yeah. So that's the cash converter business is exactly that. It's allowing people to get short-term loans. They've done a lot of work moving into loaning people money because they now have a lot of data about who they loan to, what their repayment schedules are, and they've tailored products around that sort of end of the market. So that's been working well for them. Anyway, I don't want to focus on the business per se, but look at the numbers. So they have a QAV score of 0.44 at the moment. Reasonable size, but not overly big, so average daily transaction of 90,000. Quality score is pretty good, 10 out of 13 for 77%. The yield is 3.7%, which is a good yield. And they commenced paying dividends last half, so that's actually a thing in their favour, I think, too. The fact that when a company is confident enough, or the board's confident enough to pay a dividend, I think is actually a positive. And, it might be something to put in the checklist going forward, but I haven't yet. But anyway, it's got a dividend now, and it's above the mortgage rate. Probably one of the biggest things about it is that its equity per share is 50 cents, but its share price is, 26 or so?
26.5 today.
26.5 today. So it actually has more equity per share than you're asked to pay. So you're classic case here of buying $1 worth of value for 80 cents. So that gives it some good scores when we look at the price to book ratio. I've noticed a couple of times now with my analysis in Stock Doctor, when I download price to consensus forecast, is coming up as a 1 on the checklist. But if I go into the front page of Stock Doctor, there's no consensus forecast. So not sure what's going on there. It's showing that cash converters is below its consensus forecast, but it's not telling us what that consensus forecast is. So I've raised this with Stock Doctor last week. I haven't heard back on this, but it's a case with this company and a couple of other ones. So the score may go up or down, or stay where it is, or go down slightly if we lose a point there once Stock Doctor gets to the bottom of it, but we'll see. What else? The strong financial health, and it's been steady for a while. Again, price to operating cash flow quite low of 1.74, PE of 9, return on equity of 5.86, which is low, but that's probably because there's lots of equity. So given that there's 50 cents a share of equity, you'd have to make a lot of money to give a good ROE on that stock. So that's one of the ways that ROE can mislead. But yeah, put all that together, and it's quite high on our top scorers list, and it had a 3-point turnaround in the last 6 months, and it was off the checklist because of sentiment, but it's now come back on in the last month or two.
And the most important thing on the checklist, I think, with CCC is I actually bought it for my own portfolio late last week. So the share price has obviously come back a bit since then. So it's a good time for people to have a look at it. You're welcome, everybody. I should sell it immediately.
It will definitely go up if you do that.
All right. Well, let's move on to questions then, Tony. We've got a few this week. Don't know if we'll get through them all. A couple left over from last week that we should start with. This one's from John. Hi, Cam and Tony. A while ago, Tony and Dylan did some great work looking at which factors on the checklist had the biggest impact on QAV performance. The average 20% performance that Tony has got over the years is a combination of all the factors and the sentiment. From memory, Dylan and Tony found that the price to operating cash flow made up about 13% of the 20% total, and growth in asset value was around 5%. Once Tony and Dylan have completed their analysis, are there any plans to adjust the total score calculation to weight each factor according to the research? Maybe we could run a Challenger portfolio to test it. Obviously, because the existing system works so well, there may not be any great rush to do this. Cheers, John.
Thanks, John. Yeah, so you're right. The two big heavy lifters for us are price to operating cash flow and increasing net equity. It's on the list for Dylan. We've spent a lot of time trying to get 3-point trend lines working, and shout out to Brett for his help with that. But the problem is at the moment that even though we've got a formula which looks like it works, it's just becoming too computationally intensive to go back over 10 years worth of share data and back test things. So we're trying to find a way of achieving something which is robust in terms of drawing a line, but also computationally easier to make the back testing feasible. Because otherwise it just runs for years. So that slowed us down more than I would have liked. And the fact that Dylan only really works on things on his holidays, he does work on them when school's in, but he's obviously focusing on school. It's just slowed us down. So I was hoping to be ahead of where we are, but we're not, but we're getting close. Once we get the trend line worked out, then we can back test things like playing around with the score for things like price to operating cash flow and net operating equity. Interestingly, price to operating cash flow has a big impact on our checklist anyway, because we divide the quality score by the price to operating cash flow. And as we've seen before, that price to operating cash flow of less than 7 really drives the numbers for QAV. So I don't know if we'll play around that much with that. We'll just keep dividing by that to get the final QAV number. But certainly other things in the checklist will have their weightings change once we can do some testing and optimise it.
Right.
So apologies it's taken too long, but that's just where it is.
Yeah. Oh, that's good. But at some point, we may have a modified checklist that has some different weightings.
Yeah, correct.
Thank you, John. Elmar says, I'm hearing a lot of resource development in our area. Gold mine by De Grey, magnesium mine by Element 25. Elmar works in the mines over in WA. And I'm wanting to throw money at them in order to gain the maximum possible, with 3 exclamation marks. I know it's speculative, and then in brackets read foolish, but I'd like to know how or where Tony would go to do a more in-depth analysis to take out more of the speculation. Cheers, Elmar.
Well, easy answer, the checklist. By the miners that are scoring well on the checklist. I mean, to use those 2 examples that Elmar mentioned, De Grey's mining and Element 25, if you look at those from a checklist point of view, it's De Grey's, or they both had negative operating cash flow for, I think, if not their entire life, then most of their entire life. And De Grey's listed in 2002 and Element listed in 2011, so that's a long time to be ramping up a mine and not producing any sales to cover the costs. It doesn't mean they won't next halve. They may well turn around, but that's when I'll be looking at them. But, you know, both of these are kind of typical specky miners. They're announcement driven. They'll continually try and put out a positive spin on their latest quarterly report, on their latest ore update, on their latest, the price of whatever they're mining, and try and drive a share price investment that way. But, the QAV process ignores all that. So I've never really looked hard at them, and I won't until they start shipping and we can see some cash flow. See whether all that 10, 12 years of investment's been worthwhile. The other thing about companies like that is they inevitably will ask for more money from their shareholders. They'll say, well, we're getting close to our first shipment of ore. If only we could have this rail line between our mine and the coast, we'd be able to ship, and then you're up for more money. So, or whatever it is, rail lines or exploration.
They sound like documentary filmmakers, Tony.
Yeah, they do. Yeah.
All we need is a little bit of extra money to go and do a reshoot.
Yeah, correct. Subtitle it. Translate it to different languages. Yeah. So I'm not going to touch them. I think Element 25 has recently said they're going to ship their first store soon, so we may see some positive cash flow out of them. But that's the time to look at them. Yes, you'll give up the first bit of specky share price gain, but on the other hand, you won't have invested for 11 years waiting for that first shipment of ore to turn the business into a proper business and not just the guy with a pick out in the desert somewhere,
right,
building stuff.
Right.
But there are resources out there. People do deep analysis onto these companies and can, provide good advice. So Tim Treadgold is the resource I often go to look at his analysis on mines. I hate to say it, but Hot Copper often tracks these kinds of stocks and will have opinions, but they are opinions rather than being necessarily based in hard data. And the same with Google News. If you see a share price suddenly go up or go down, have a look at Google News and see if you can work out what drove it. But these companies are usually driven by announcements. Yes, we've just struck a new low. Our exploration has been good. We have more reserves under management, all that kind of stuff. But they're not the kinds of things that I want to look at or invest in.
So the fact that a mine is doing a lot of development doesn't really impress you a great deal. It's you want to see money in the bank. Yeah,
it's kind of worries me in some respects because they would have asked people to pay for that recently, or they're about to ask people to pay for it in the future. So you need to wait until you get some cash flow in to pay for these kinds of things before you can really assess whether it's worthwhile from an investing point of view.
Yeah. Okay, thanks. Thank you, Elmar. John, again, or another John, who knows? Hi, Cam, how are you? I'm good, thanks, John. Thanks for asking. In the last podcast, you mentioned the frustration of calculating your annual return when your capital invested varies over the year. That was a couple ago. But yeah, and by the way, I've reached out to Stock Doctor and asked them if they can make someone available to come on and talk about how to do that in Stock Doctor. And they haven't really got back to me on that yet, but fingers crossed. This information is all held by your online broker, says John, and so can be calculated by them. We use several online brokers, unfortunately. You can set the date range and then tell it to do a time-weighted average or a money-weighted average calculation. The money-weighted works well if you've been moving capital in and out. You can also decide on a benchmark, and it plots a graph showing how the capital has moved over time. Another tip to look out for, the broker should be able to provide a list of transactions that you can download into MS Excel or Google Sheets and send to your accountant. This speeds up the capital gains tax calcs for your tax returns. Considering cost per trade is only around $6, this is a pretty good service. I think he's talking about Interactive Brokers there as the broker. This is a pretty good service and probably should be part of the decision as to which broker to pick. I imagine some of the more expensive brokers have this service too. Would be interesting to know. Looking forward to hearing your son break into a podcast with his lightsaber. Well, he could, except he and his mother took the lightsabers to a park to play with about a month ago. And then about 2 weeks later, Fox was like, "Where's my lightsabers?" And we realised they'd left them there.
Oh, no.
Left them at the park. So lightsabers are gone. But thank you, John. Yeah, money-weighted and time-weighted. I know that both Navexa and ShareSide and Stock Doctor all have those. But I'm still not sure how it works or how to read it. And I guess I could read up on it and understand it a little bit.
Yeah, no, I appreciate that. And as we spoke about before, I think if you've got a small portfolio where you've taken money in and out, any of those calculations are going to look a bit strange. So,
right.
I thought a bit more about what we were talking about. The way that I'd probably approach it is to drop your trades into Excel and then trade by trade or company by company, look at how much capital you deployed in that investment and whether it made money or not. And then, do a weighted average. So basically, for example, if you had $1,000 in MML for 3 months and it went up $100, that's a 10% profit over 3 months. Yeah. Just as an example. If you had $1,000 in CCP, Credit Corp, and it went up, if you made $300 over 2 months or 3 months, then you've got a 30% return. And if you add up all of those different transactions for the companies that you've had, and then divide them to get an average per month, and then multiply that by 12. That's probably the closest you'll get to a weighted average for the year. Does that make sense?
So get the returns for each stock, and then work out what the return is per month, depending on how long you had carried the investment. And
you might need to do it per week if you've sold them quickly.
Right. And then add all of those final results up.
Yeah, so you'll need to take into account the capital. So it's a weighted average. So if you had stock A with $1,000 in it for this period and you made or lost this much, that's the first entry in your spreadsheet. And then stock B, you do the same. So you tally up all the capital that was invested, tally up all the money you made, and get an average over the time period, whether it's weeks or months, and then multiply that out to get a yearly value. Yeah, I know. Bit of mucking around.
Dylan busy over the next week? I get...
He is.
Damn it. Dave from Newey. Hi, Cameron. Long-time listener, medium-term subscriber, first-time questioner. First, thank you wholeheartedly to you and Tony for what you're doing with QAV. In short, this shit works. Thanks for confirming, Dave from Newey.
Good on you, Dave.
Performance. I started allocating share investing capital to QAV in early April and now have 60 to 70% of my book in top scorer companies. My winners/loser ratio and returns are aligned with the long-term QAV results. Well done. I've missed a couple of the big winners, nailed a few solid performers, and had a dud or two. I'm cautious of the late market stage. I literally started at all-time highs. So I'm using tight trailing sell orders set at break even once a stock has risen a bit to respect Buffett rule number 1. Well, you're way ahead of me, Dave. I wish I'd listened to you. This has exited me early, pre-3PTL, on a few positions. A couple of those have cost me, a couple saved me. I'm also doing a bit of fudging, e.g. I've bought from down the bottom of the list when I like a company. I've scored a couple of winners doing this that are continuing to perform. Also, I've plucked 3 companies off the watch list prior to a buy 3PTL signal on the basis they will keep going. 2 have worked, 1 is hovering where I bought it. I also had 2 I was looking at but didn't buy and went on to return positively 40% and 100%. Mm-hmm. So this is something I'm grappling with. How to identify the stocks that have started their uptrend and will keep going and getting in earlier than the 3-point trend line buy signal and therefore exponentially increasing gains from the winners. An initial observation, a common theme in the watch list winners has been very low price to cash, suggesting the market can't resist them eventually, or very high quality, suggesting the uptrend is based on solid foundations and will continue to a 3PTL breach. Let me stop there and pause for breath. Tony, any comments on that so far?
Oh, look, he sounds like he invests like I do. Looking at the watch list, occasionally buying something from the bottom, selling out for rule 1, all those things are exactly what I do. So good on you. In terms of getting things early, it's very tempting, and occasionally I do, but I've been a bit more disciplined lately. It can go either way. So what he's saying is that if you think about the banks last year, generally what happens is we'll get a company that comes out of reporting season where the score has just gone from bad to good, the quality score, I mean. And even the QAV score has gone from bad to good if you ignore the fact that they haven't reached their 3-point buy price yet. And so you have a look at the graph and you say, well, the share price is a long way from the buy price, but this is going up. And then it's just a line ball. It's just a captain's choice. It's a pick as to whether you want to invest in that company or not and take the risk that it keeps on going. So that's certainly open to people to do. I've done it from time to time. Generally it's with a company I know a lot about. And I guess that was the basis for fudging some of those companies as well. That I was looking for a buy price that was lower than it would have been drawing a traditional 3-point trend line. So I get it. It's the age-old story though. Like there's so many stocks on the top scorers list. Do you need to go looking for things early? Really? That's kind of where my thinking is at the moment. But yeah, certainly go for it if you want to.
Dave continues, so I read Roger Montgomery's book, Valuable. One of the key takeaways for me was to look for companies that have an ROE of greater than 20% and then buy them when they're cheap. So I set up a filter in Stock Doctor. By my reckoning, 90+% of companies this filter returns have appeared on QAV lists since I've been involved. And more importantly, most of the real big winners I've seen are there too. AIS, GRR, CAA, etc. So I'm considering adding an item to the checklist. Is ROE greater than 20%? One for a yes, blank for a no, so it's a booster. Would appreciate Tony's thoughts.
Yeah, look, ROE's come up a couple of times from our listeners, and it's the kind of first metric that investors will tell you to look at. But that's had a couple of downsides to it over the years. The first one being that it means that management can game ROE to make it look more attractive for people to invest in the company. And we already saw before with cash converters, they have a relatively low ROE of about 5 or 6%, which I don't think is a bad metric in their case. They just have lots of equity. So equity is the divider in return on equity. And if you have lots of equity, which was something we look for, then you have to have a really, really big return to also have a high ROE. So that's the first thing. Second thing is ROE can be manipulated by taking on debt. And remember that equity is assets minus liabilities. So I would much rather buy a company with low debt and low ROE because there's lots of equity, rather than buying a company with high ROE because the equity's has shrunk because they've taken on lots of debt. And this was the case, probably not so much these days. I think a lot of analysts have learnt their lessons, but say over the last 20 years, maybe back in the 90s in particular, there was this whole mantra of getting rid of lazy balance sheets. And corporate advisors, stock analysts, investment bankers would just descend on companies like a cash converters and say to them, you've got a lazy balance sheet, your ROE's low, you've got all these assets you could be leveraging, why aren't you out there borrowing money and doubling in size? And of course all that did was introduce a whole heap of risk to these companies which were really solid, really well managed, but they were set upon by people who wanted to get a high ROE. And so, that's what happens in the investment world. People, focus on one metric, and it's a bit like your health. You can't sort of say, eating fish oil supplements will lead to a longer life because, it's a good antioxidant. That's just one part of a healthy diet. Focus on the rest of your diet rather than just taking your fish oil supplement. It's a bit the same with ROE. It's one metric, and it's been done to death over the years. It's been gamed over the years. So I'm a bit wary of it. Having said that, I went through the top scorers list and had a look, and there's kind of a split between high ROE, as James has said. Dave, is it? Sorry, thank you. I did go back to the last page. Dave from Newey, as Dave has said. But there's also lots of companies which have low ROEs, and some which even have negative ROEs. So it's actually an interesting thing to analyse. So I'm going to ask Dave to set up a couple of portfolios in Stock Doctor or whatever he uses, just a couple of dummy portfolios, and I'll do the same, and I'll go back through my old records and try and do it from maybe 18 months ago and just put the top scorers list into those with a ROE above 20% and those below 20%. And let's just see if there's any meaningful difference to those two, pools of stocks, and maybe even have a third one, those with negative ROE, because that's also on our list. So I'm looking at companies like Myer, which have a negative ROE, but they've done well for us, just as well as those with a high ROE have done. So
Myer's done great for me.
Yeah. So let's have a look, and then come back and compare results. And maybe he's right. Maybe we should put the foot on the scales when it comes to high ROE, but let's just prove it first.
There you go, Dave. There's your homework. Well, Dave's got a few more questions, and there's a couple of others from Duncan and Michael, but I think we're well over time. So let's save those for next week, Tone.
Okay, sure.
Quickly, watched anything, read anything that you can recommend to us this week?
No, not really. Been watching the golf at the Olympics, which has been fun. Can't recommend anything else, really. Watched a couple of crappy movies, which I wouldn't recommend. Reading So You Think You Know What's Good For You, which is the Norman Swan book, which is good. That's why I talked about supplements, because he poo-poos supplements in it. But so that's a good read. And that's probably following on from the comments last week or on the Facebook group about being immortal and what the compound interest would be like if you had a longer life. So,
by the way,
that's worth doing.
A very old friend of mine who runs the biggest supplements company in Australia told me over lunch a few years ago, yeah, most supplements are bullshit. They do nothing for you. They're all placebo.
Really? Yeah. I remember reading The Singularity is Near, and then the sequel to that by Kurzweil. I think it was something about, live long enough to live forever. And he talks about, how to live longer and take supplements. And then he refers you to his website where he sells supplements. And I just thought that was a bit self-serving.
He doesn't make enough money at Google.
Yeah, that's right.
I watched Nights of Cabiria. Di Notti di Cabiria, or Le Notte di Cabiria. Fellini film, 1957, I think, won the Academy Award for Best Foreign Movie, and I think his wife won Best Actress in a foreign movie or something for it. Yeah, really good. If you like a bit of old Italian classics.
I do.
Well, unfortunately, at this juncture, we had technical problems with Tony's microphone, and we had to just cut it. So that is the show for this week. I do want to point out that, again, I'm editing this the following day, Tuesday, the 3rd of August. CCV, Tony's Pulled Pork of the Week, has now dropped more than 5% below what I paid for it last week. So I think I am going to have to invoke Rule 1. The episode didn't even go out, and this has happened. Tony just had to talk about it. And I don't know, the internet, the ears, everybody's listening. It's already dropped below my buy price, so now I'm going to have to sell it as soon as I finish editing the show. So thanks a lot, Tony. Hope you pick something different. Next week, I have to make a rule from now on when Tony picks a pulled pork. It's not a stock that I own. On the flip side, glad he didn't talk about AIS, Aeris Resources, because it's up 14% already today, and it's only 1:30 in the afternoon. So that's a beauty. But yeah, CCV dropped 5% today for some reason. Anywho, them's the breaks. Have a great week, folks. Talk to you soon. Ciao. Stay safe.